If you went to sleep thinking the silver market was still intact, you woke up in a different reality. While America was offline, the market didn't correct, didn't rally, didn't fluctuate. It split cleanly, east versus west. Two prices, two truths, one asset. This happened quietly overnight, without a headline or a breaking news banner. Physical silver in the east traded at triple digits, while the Western screens you're being shown this morning still insist everything is normal. That disconnect is not a glitch. It's not volatility. It's a structural failure, and once you understand it, you can't unsee it. Financial media will tell you this is temporary, a regional anomaly, something you don't need to worry about. That message isn't designed to inform you. It's designed to slow you down because moments like this don't come with warning labels. By the time they're explained on television, the positioning phase is already over. I'm not here to talk about chart patterns or weekly candles. I'm here to talk about mechanics, about what happens when two major markets stop agreeing on price and physical metal starts moving instead of paper contracts rolling over. I've spent years tracking vault inventories, delivery flows, and arbitrage pressure that never shows up on retail dashboards. When those signals align, markets don't reverse. They reset. What just happened isn't about silver going up. It's about the pricing structure breaking down while most people were asleep. The screens you're looking at are backward-looking. The physical market isn't. And when those two diverge, history moves fast and explanations come late. If you want to understand what just changed and why this matters far more than a price spike, you need to see what happened beneath the surface last night. Because the silver market you woke up to today is not the same one that existed yesterday. If you're here for real analysis, not reassurance, subscribe and stay alert. Press 1. In the comments, if you're ready to move past the noise and into the data. To see why last night mattered, you have to look past price and into structure. Markets don't collapse at the headline level. They fail at the seams. And the seam that tore open overnight was arbitrage, the mechanism that normally keeps global prices aligned. In a functioning market, the same asset can't trade at meaningfully different prices in two regions for long. If it does, capital moves to close the gap. When that movement is paper-based, it's manageable. When it becomes physical, it's destabilizing. That's the line we crossed. Western silver pricing is built on futures rolling contracts and cash settlement layered over a limited pool of deliverable metal. It works as long as most participants never ask for bars. Eastern markets operate differently. Physical delivery is central, not optional. When demand rises, their metal has to be sourced immediately. Overnight, those two systems stopped agreeing. The East paid up for real silver. The West kept quoting paper. That difference wasn't cosmetic. It was large enough to create a mechanical incentive. Buy metal where it's cheap. Move it. Sell it where it's expensive. No forecast required. Once that incentive appears, sentiment becomes irrelevant. Bars leave vaults. Registered inventory shrinks. The cheaper market bleeds supply until one of two things happens: prices rise or metal runs out. There is no stable middle ground. Calling this a temporary distortion misses the point. The price print was just the signal. The real event was the activation of physical flow. And physical flow doesn't reverse because someone downplays it on television. This is no longer a discussion about whether silver should be higher. It's about how long the current structure can survive under this pressure. And that brings us to the numbers that locked this imbalance in place. Now let's anchor this in hard data, because structure without numbers is just theory. The snapshot taken in the early hours of the New York morning tells a very specific story, and it's one the Western market would prefer you not focus on for too long. Gold, the anchor of the precious metals complex, is behaving exactly as you would expect in a controlled bull market. It's been grinding higher inside a well-defined rising channel for weeks, steady and disciplined. No panic, no blow-off, just controlled pressure. That kind of movement doesn't attract headlines, but it provides a foundation. And that foundation matters more than most people realize. Silver, on the other hand, stopped behaving like a follower. While gold moved incrementally, silver accelerated. Not by a little, but by a multiple. When one asset in a tightly linked pair suddenly begins to outperform the other at a 4-to-1 ratio, something has changed beneath the surface. That's not rotation, that's leadership flipping. This is where most casual observers get confused. They see a percentage move and assume speculation. But markets don't care about percentages. They care about relationships. And the most important relationship in this space is the gold to silver ratio. It tells you whether silver is lagging, leading, or mispriced relative to its monetary anchor. At the moment, this imbalance locked in that ratio began compressing fast, not drifting, compressing. That tells you silver isn't just rising because traders are enthusiastic. It's rising because it's being pulled by something heavier than sentiment. When silver starts moving multiples faster than gold, you are no longer in the accumulation phase. You're entering the acceleration phase. This is the part of the cycle where the market stops asking permission. Moves that normally take months happen in days. Gaps that shouldn't exist get closed violently. And here's the key point most people miss. This phase doesn't begin when retail notices. It begins when the math stops working for the existing structure. That's where we are now. The ratio is compressing, the anchor is holding, and silver is no longer waiting. The question isn't whether this is unusual. It is. The question is what happens next when that compression continues. And to answer that, we need to look directly at the gap the market is trying to close. The gap the market is trying to close is not abstract. It's measurable, persistent, and already forcing behavior. Western prices are still being set by paper-heavy systems. Eastern prices reflect what buyers are paying to remove metal from circulation. When that difference is small, it resolves quietly. When it becomes double-digit, it changes everything. At that point, arbitrage stops being optional. It becomes mechanical. Buy where it's cheap. Sell where it's expensive. No thesis required. No belief system involved. Just math. And when math takes over, markets don't stabilize, they drain. This is where the Western exchanges run into a structural problem. Their pricing model assumes most participants prefer convenience over delivery. Paper rolls, cash settles, and the metal stays put. That assumption only works when the incentive to demand physical is low. A wide arbitrage gap destroys that balance. Once delivery becomes profitable, inventory starts to matter. Registered supply isn't designed for sustained outflows. It's a buffer, not a reservoir. And buffers collapse faster than most people expect when metal leaves and doesn't return. Every ounce shipped tightens conditions. Every delay in price adjustment accelerates the process. The critical mistake is believing this can resolve gently. Markets don't close gaps politely. They close them through either price movement or supply exhaustion. Right now, price is lagging, so metal is moving instead. That's why calling this temporary misses the point. Temporary dislocations don't pull metal out of vaults. Incentives do, and incentives persist until they're neutralized. At this stage, the market isn't negotiating value anymore. It's enforcing it. And enforcement only responds to supply, demand, and time. The longer the gap stays open, the more unstable the structure becomes. Which brings us to the real risk. What happens when physical demand overwhelms paper control? When physical demand begins to override paper control, liquidity stops being what it appears. On screens, silver still looks plentiful. Contracts trade smoothly, volume remains high, and the system projects confidence, but paper liquidity only exists as long as it isn't challenged. Physical demand is that challenge. Western silver markets run on a fractional model. A relatively small pool of registered metal supports a much larger volume of claims. That structure works in calm conditions. It breaks under delivery pressure. The issue isn't intent or manipulation, it's capacity. Too many claims chasing limited metal exposes the limits of the system. Arbitrage accelerates this exposure when taking delivery becomes profitable. Contracts stop being abstract bets and start becoming tools to access inventory. That shift changes behavior fast. Participants who would normally roll positions begin standing for metal. And once that behavior spreads, control weakens. Paper markets can absorb speculation. They cannot absorb sustained physical drawdowns. Each delivery request removes optionality. Each ounce leaving registered supply tightens conditions further. Volatility rises not because traders panic, but because flexibility disappears. This is usually when exchanges intervene, margin hikes, rule adjustments. temporary measures designed to discourage participation. These tools are effective against leverage. They are ineffective against physical incentives. You can price out speculation. You cannot price out arbitrage when the gap is large enough. At that point, the system faces a binary choice. Let price rise and close the gap, or restrict access and signal stress. Neither outcome restores confidence. Both confirm it's already gone. This isn't a failure scenario, it's a repricing of this process. And repricing doesn't begin with headlines, it begins when existing mechanisms stop working. The pressure is already here. The remaining question is how far the repricing goes, and that's governed by the one metric that ties gold and silver together. The metric that ultimately governs this entire structure is the gold to silver ratio. Strip away the commentary, the narratives, and the noise, and this ratio is what tells you whether silver is lagging, leading, or being repriced. It's not a prediction tool, it's a pressure gauge. For long stretches of time, the ratio moves slowly. It oscillates within historical bounds as markets digest information. That's what a stable system looks like. What we're seeing now is not oscillation, it's compression. And compression is never neutral. It's energy building inside the structure. When gold holds its ground and silver accelerates, the ratio has only one direction to go: down. That doesn't require optimism, it requires arithmetic. If gold remains steady and silver rises faster, the ratio collapses whether anyone believes in the move or not. This is why silver outperforming gold matters more than absolute price. Leadership shift signals that the market is no longer treating silver as a secondary asset. It's being pulled into a repricing cycle driven by physical demand and arbitrage pressure, not speculative enthusiasm. Historically, when the ratio compresses rapidly, markets are already late in the process. The early phase happens quietly while positioning is still possible without attention. The acceleration phase happens fast once the imbalance becomes obvious. That's where we are now. The mistake is assuming the ratio will stabilize on its own. Ratios don't stabilize, they resolve. Either silver stalls and gives back ground, or gold follows higher, or both. What doesn't happen is a quiet return to equilibrium without price movement. If gold breaks down, the structure fails and silver follows lower. If gold holds, silver has room to run far beyond what feels reasonable. That's not opinion. That's how the relationship has behaved for decades. Right now, the anchor is intact, and the compression is active, which means the system is moving toward resolution, not rest, and that resolution has a number attached to it that most people aren't prepared to accept yet. Enter 1 to continue to cha. As markets move toward resolution, behavior changes abruptly. The conversation shifts from whether something can happen to whether participants are positioned for it. This is not retail panic, it's institutional urgency, and it shows up before price reacts. At this stage, stress becomes operational. Vault inventories are monitored closely. Delivery timelines matter. Physical premiums begin to separate from quoted prices. These signals appear quietly long before they make headlines. Many assume institutions can simply suppress the move. That belief confuses paper control with physical control. Paper can be expanded indefinitely. Metal cannot. Suppression works when pressure is speculative. It fails when pressure is driven by physical movement. This is where defensive measures emerge. Margin hikes, rule adjustments, temporary controls framed as risk management. These actions don't signal strength. They signal containment. They slow participation but do nothing to remove the underlying incentive. Importantly, these measures rarely mark the end. They mark the midpoint. They shake out weak positioning and buy time, but they also confirm stress exists. Markets recognize that signal quickly. As confidence in paper weakens, behavior shifts towards certainty. Allocated exposure, physical-backed positions, reduced reliance on promises. This transition doesn't require panic, it requires calculation. This is the recognition phase. Not everyone sees it yet, but the process is already underway. And once recognition spreads, price tends to move faster than comfort allows. Recognition changes the character of a market. Once enough participants understand what's happening, the focus shifts from analysis to execution. The question is no longer why the imbalance exists, but how long it can persist. That's when volatility stops being random and starts becoming directional. At this point, media narratives usually lag reality. Coverage narrows. Certain data points stop being emphasized. Attention is redirected toward short-term explanations that make the situation feel contained. This isn't coordination, it's inertia. Large systems are slow to acknowledge structural stress because doing so creates accountability. Meanwhile, activity on the ground tells a different story. Premiums at the retail level widen. Availability becomes inconsistent. Allocated programs quietly restrict inflows. These aren't panic signals, they're capacity signals. They indicate that supply is being absorbed faster than it's being replenished. The mistake is waiting for confirmation from price alone. Price reacts last. Physical flow reacts first. When enough metal has moved, price has no choice but to follow. That's why recognition phases are uncomfortable. They force decisions without full clarity. This is also where risk increases. Moves become sharper. Pullbacks are violent and short-lived. Anyone operating on leverage feels that pressure immediately. Anyone relying on promises begins to reassess counterparty risk. None of this guarantees a straight line higher. It guarantees instability. Instability is the environment where repricing happens, and repricing doesn't unfold on a schedule that feels reasonable. The window during recognition is narrow. Too early feels wrong. Too late feels obvious. Positioning happens in between when conviction is required, but certainty is unavailable. This is the phase we're entering now. The groundwork is laid, the pressure is visible. And the next shift won't be subtle. It will be numerical. When markets reach this stage, the math stops being abstract and starts producing unavoidable targets. This is where narratives fail and numbers take over. Once structure, flow, and ratio align, the range of possible outcomes narrows quickly. Not because the future is known, but because the system has fewer ways to absorb pressure. At this point, price targets aren't forecasts, they're implications. If gold holds its anchor and the ratio continues to compress, silver doesn't need enthusiasm to move higher. It needs resolution, and resolution expresses itself through price, whether participants are comfortable with it or not. This is why certain levels matter more than others. Breakpoints signal acceptance, when markets cross them and fail to reverse behavior shifts. Hesitation turns into chase. Caution turns into adjustment. That's when moves accelerate, not because fundamentals changed overnight, but because recognition reached critical mass. This phase is where mistakes are most often made. Some freeze waiting for certainty that never comes. Others overcommit assuming momentum will protect them. Neither approach works well in unstable conditions. The only advantage comes from preparation, not reaction. It's also where asymmetry peaks. Upside expands quickly, but downside risk doesn't disappear. Volatility becomes the cost of participation. Anyone without a plan ends up making decisions under pressure, and pressure rarely produces good outcomes. The market doesn't care who understands it best. It cares who acts with discipline when conditions change. That's what separates those who benefit from repricing from those who watch it happen. We're close enough now that the final variable matters more than all the others combined. Not silver, not arbitrage, not even the ratio, the foundation beneath it all. Because if that foundation holds, the resolution becomes unavoidable. And if it doesn't, everything resets in a very different direction. Everything comes down to the foundation. Gold is the anchor beneath this entire structure. Silver can accelerate ratios, can compress arbitrage, can drain supply, but if the anchor fails, the system resets in the opposite direction. That's the final filter, and it's the one variable that must be respected above all others. If gold holds its structure, silver's repricing is not optional. It's mechanical. The pressure already in the system has to resolve somewhere, and price is the release valve. That's how markets clear imbalances of this magnitude. Slowly at first, then violently, then all at once. If gold breaks down, the thesis pauses. Not forever, but long enough to reset positioning and expectations. That's not failure. That's discipline. Knowing when not to act is just as important as knowing when to move. The lesson here isn't about chasing silver or predicting numbers. It's about understanding structure before headlines, about recognizing when paper signals diverge from physical reality, about knowing that markets reward preparation, not comfort. If you're holding physical metal as a long-term hedge, the core thesis hasn't weakened. If you're positioning for repricing, you need a plan. Entry matters, exit matters more. Parabolic moves always end, and they punish anyone who believes they won't. Take profits in stages. Reduce risk when volatility expands. Don't confuse conviction with stubbornness. Above all, avoid decisions driven by fear of missing out or fear of being wrong. Both are